Be Wealthy and Smart, episode 1576.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about low inflation data, which may fuel interest rate cuts. So we received the September Consumer Price Index report today, which was delayed because of the U.S. government shutdown, but it showed that inflation rose 0.3% for the month, bringing the annual inflation rate to 3%, according to the Bureau of Labor Statistics. That's just below the 0.4% and 3.1% that economists polled by Dow Jones had expected. When excluding food and energy, Core Consumer Price Index came in at 0.2% last month and 3% on a 12-month basis, also lighter than the Dow Jones forecast for 0.3% and 3.1%. Following the CPI data, traders increased their bets that the Fed will cut rates at both its remaining two meetings this year. Odds for a December rate cut jumped to 98.5% from 91% odds before the data, according to the CME FedWatch tool. Odds for a cut next week remained around 98 to 99%. Although the headline inflation data annually did represent a slight uptick from the prior month, most government economic data, including weekly and monthly jobs figures, remains postponed because of the shutdown. Lindsay Rosner, head of multi-sector fixed income investing at Goldman Sachs Asset Management, said, "There was little in today's benign CPI report to spook the Fed, and we continue to expect further easing at the next week's Fed meeting. A December rate cut also remains likely within the current data drought, providing the Fed with little reason to deviate from the path set out in the dot plot." The third quarter of earnings season has been off to a hot start, with about 30% of the S&P 500 having reported so far, and a staggering 87% of companies that have reported have beat their earnings, while 82% have topped Wall Street revenue expectations. In terms of a beat rate, those are far greater beat rates than the typical 67% earnings beat rate and the 62% average revenue beat rate, according to LSEG. Incredibly, this season, 3 out of every 4 companies have reported they have posted a double beat, topping both earnings and revenue estimates, according to LSEG senior analyst Tajinder Dhillon. Compare that to the 69% double beat rate last season in the second quarter and the far less impressive 54% back in the first quarter. All that is leading to yet another double-digit earnings growth rate this season. The S&P 500 earnings are now on track to rise 10.4% from a year ago. Although it's not yet the 13% growth seen in the first and second quarters, it has risen since earnings season began. More momentum could be in store during the busiest week of earnings season next week, when nearly one-third of S&P 500 companies are reporting, and 5 of the largest, the Magnificent 7 companies, will be out with results: Alphabet, Microsoft, Meta, Amazon, and Apple. And today, the Dow rose 400% and the S&P hit a brand new record. Things are looking very positive in terms of earnings, which is underlying the stock market, and for lower rates ahead, which has our forecast of a rising stock market, crypto market, and real estate market looking very good indeed. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.